We get one big down day and the Bears claim a premature victory. However, as of Friday's close, we're better than unchanged on the week and we're still sitting in an overall daily uptrend. This upcoming week, we get more earnings reports and more economic data. However, after what Powell noted during the press conference post FOMC, the non-farm payroll report and the unemployment rate coming out this Friday should be the data that keeps the market holding its breath. So as always, let's keep a level head and build a game plan for the coming week's worth of trade that's based on logic and not emotion. Check out the links listed down below in the description. We still have a couple of card holders left. Hit the thumbs up button and subscribe if you've not already done so. And stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, talking about candle structure and location as we always do. For structure, and I totally get it, there's still one day left in July, but for structure, we are dealing with a solid green-bodied bar, not much to read into from an upper and lower wick perspective psychologically, and we are intending to close towards the top of the monthly range, so buyers get a check mark for a structure perspective. If we think about location on the bar-to-bar count, we've got ourselves a higher low as well as a higher high. Buyers go 2 for 2 from that perspective. If we think about the longer-term pattern that's in play, we've been talking about the monthly inverted head and shoulders, and we've broken out over the neckline now for a couple of months. And of course, we are at the measured move and prior structure from off to the left. So is it logical? Here's the measured move, by the way, the neckline to the head, then the neckline, and you project that going forward. That's roughly an eyeball test right on the money with our prior structure from back here. But the question I was getting towards, is it logical that the monthly time frame chart could slow down towards this pivot top? Is it reasonable that we could afford a monthly higher low pullback? The answer to me is absolutely yes. And of course, the retest just wants to be anywhere above the neckline breakout point, which we know to be the 420 level from all the weekly analysis we've been doing over the past couple of months here. We're going to change our tone for the higher low on the weekly in just a moment, but we'll get to that when we get to it. The next thing I want to share with you are the Fibonacci perspectives coming in from the low up to the high. And this is the sickness low, by the way, to the all-time high. We, of course, know that we've defended the 50% retracement and we're well above the 38.2, meaning that this, of course, feels much more so like bull flag consolidation on a monthly time frame chart. Don't get me wrong, it was nasty throughout 2022, but from this higher time frame perspective, it was a very mild and reasonable pullback, and now we're gunning back up towards that, all-time high, basically, the 100% retracement. That would be from this perspective, all-time high to the October lows on a monthly closing basis. Of course, we're well above the 61.8, and the more time we can spend above the 61.8, the higher the odds of that 100% retracement. The last Fibonacci perspective I would share with you is coming from the low. If this truly does mark the high, which once again, if we extend this off to the left, if we back off from resistance right here, where's the 38.2 keeping us in bull flag consolidation from this perspective right here? It's certainly right at our key zone. You can't make this stuff up. It's the 420 level. It's also the 50% retracement from the all-time high to the October low. So 420 on a pullback is making a lot of sense on the monthly time frame chart. It would be a big old break and retest for a higher low. You've got lows, higher lows, and thus the monthly trend remains in the upward direction. Now, something that you're going to start hearing about from a lot of folks, be it online, Twitter, social media, whatever, is the big opportunity for this to turn into a monthly double top. And sure, the markets can always do whatever they want to do, but it would be very unlikely statistically that this truly turns into a double top pattern. As we know, you need to take out the neckline and bring in the lower low before we can call it a double top. If we do end up doing something like this, of course, there will be downside outcomes to trade for in here, and we'll flip and change our tone on the daily chart, then the weekly chart, and so on and so forth. But for now, that's a big stretch to make on the monthly time frame. Let me show you why the double top is not so much something that has ever played out in the SPX. We're going to go to the SPX because we get more price history here. And if we look through history, we don't want the fibs. We want to change this to a logarithmic scale, though, so we will do that together. If you look throughout history, the big indications that are similar for the double top, sure, again, this is a nasty waterfall type sell. We know that's the great financial crisis. But how much follow through was there actually underneath the neckline of the double top? Hardly any, right? That's exactly almost where we reverse from. If we look back through history even further, remember that this is where we struggled with hyperinflation 70s and into the 80s. If you want to count this as a double top, here's your neckline. Again, how much follow through actually took place underneath the neckline? Not a whole lot. You can go ahead and find other examples of this on the monthly time frame chart, but the point I'm trying to illustrate is that it's easy for humans to want to wrap their brains around saying, oh, look at this, two perfect touches, it's an M pattern, it's a double top, we can understand that we're bearish underneath the neckline, but history would suggest that there's likely not going to be very much follow through, if any at all, if we get there in the first place. Instead, what I would encourage you to think about on the monthly time frame chart is there an opportunity for this to turn into a cup and handle? Is there an opportunity to just look at it through the lens of bull flag if we get a monthly breakdown? And again, nothing about this chart would suggest this at all, but if we do break down, is it possible for a cup and handle or bull flag to support over that 420 level we just talked about on the SPY? To me, that seems far more likely than an Armageddon type breakdown where all of a sudden we take out the neckline of the double top and we're headed down towards zero. Just the market history would not support that as an overall thesis. Let's move back on over to the SPY and we'll drop it on down to a weekly time frame chart. I'm just going to turn this off from the logarithmic scale as well. Thank you for bearing with me. But in terms of structure and location here, small bodied green bar, so it's definitely more bullish than bearish. The most important takeaway is from a location standpoint. On the bar to bar count, we of course produced a higher low as well as a higher high. The reason that is so substantial is because last week we talked all about the change in tone with the weekly inverted hammer. If the sellers were really going to step up here, we would have required a lower low on the bar to bar count, and we should have been looking for a retracement back down into this as a balance range. We of course know that on the weekly time frame chart, we are in a bullish trend with lows, higher lows, higher lows, higher lows. I would start advocating for these soft lows actually just becoming the key set of lows that we want to stay above on the weekly time frame chart. Sure, we never flipped into a daily downtrend over here, but as we extend away from it, it's going to be difficult to make the argument that a pullback could go all the way down to 420 without really jeopardizing the weekly trend. So I want to remind you of what we had back here, right? We had a balance range and we had a balance range. We had a look above and we had a fail, right? So what takes place is that we make a higher high, trapping new money longs, and then everybody, even from the range of balance back here, gets disappointed as we make a new lower low. So thus, on the weekly time frame chart going forward, what I would be an advocate for is that clearly a break and retest on the top of the range is picture perfect on the bull side, and that would be your ideal higher low. We know that to be 444 from the daily analysis that we were doing over the past couple of weeks here. Where the larger downside comes in is underneath the bottom of this weekly balance range, and that number is closer to 432. And once again, in terms of a larger trend reversal right now, nothing about the weekly structure that we just produced is indicative of a larger drawdown that would jeopardize that 432 level that we were just discussing. In terms of the anchored VWAPs, let's throw them on there just so we can see what's going on from that perspective. I would argue that they're providing confluence around the 420 still, which as we know is the monthly higher low pullback zone. And if we take a look at the volume profile, this gets interesting, right? The high volume node that we just broke out over, it's the top of the range that we just discussed when we were zoomed in on the weekly, can now possibly act as support for a break and retest here at the 444 level. So 444 strikes me as the key line in the sand on the weekly time frame chart. The monthly now is going to start being closer to that 420-ish zone. What else do we have going on here? In terms of upper high volume nodes, not much to write home about. These are lower volume. Obviously, they don't even hold a candle, no pun intended, to the high volume nodes that we have back here. This high volume node still obviously confluence around the 420. So overall, the higher time frame perspectives look pretty bullish. And once again, I would not be thinking about double top. I would be thinking about, can this turn into a larger cup and handle if we see volatility in the first place? But let's take a look at the daily. I'll show you why I don't think that new money sellers are getting active even still. First things first, if you're using Thinkorswim, please correct Friday's bar to reflect a true low of 455.06. Once again, that true low is 455.06. If you don't know how to correct bars in Thinkorswim, check out the video tutorial in the top right-hand corner. What's going on here from an expected move perspective? If we take a look at this, and if you're not familiar with this study, by the way, check out this different video tutorial now in the top right-hand corner. If we're contained by the upper bound, the number is 462.39. That, of course, would imply a higher high. If we're contained by the lower bound, the number is 451.50, and that's an equal low on par with the breakdown from Thursday's session, as well as 2 Thursdays ago when we got the Netflix and Tesla earnings reports. So overall expected move strikes me as being bullish to slightly neutral with the indication of an equal low. If we think about the overall trend that's in place, we just gapped up to a brand new higher high on the Thursday session. And even if you wanted to use a closing basis for your higher highs and higher lows, your Friday close is certainly a higher high. Obviously, we closed weak on Thursday, but Friday did close strong up and over the top of a daily balance. We'll get to that in just a second. But from a trend perspective, I want to remind you that we're cautiously bullish up here at these highs for a number of reasons, but this one perhaps is the best illustration. If we come in with the trend channels channels. And I just show you the top of the trend channel once again. We talked about this in last week's episode. There's the top. We're right at the top. We gapped into that on Thursday and faded off of it. We could do a similar thing with our minor trend channel coming from here. And if we do the top of the trend channel there, so your anchor gets touched here, 1 and 2, then you get the top of the trend channel, top of the trend channel, top of the trend channel. Those are confluence for resistance. Now, this is not an argument to go out and short the market with both hands. It's just being cautious about new money longs, right? And another reason that you might not want to short this market is because, as we pointed out, we're in an uptrend, obviously. We're looking to buy pullbacks. But if we think about the implications of Thursday, it's very, very interesting here. So we get a gap up, and we start to go for a gap fill reversal intraday. We'll see this on the hourly in just a moment. And then it's the Bank of Japan news, obviously, that sends the markets lower and produces the bearish engulfing bar. But notice that the bearish engulfer stops directly at our prior pullback low. If stronger sellers were going to be getting involved in here, number one, you would have thought that we could have gotten some follow through that low and not precisely stopped at a structural level that only short-term traders are really paying attention to. So that's issue number one. Number two is that the volume doesn't really compute for a larger downside move. Usually on an emotional route like this, if you're going to see follow through, you get volume that looks like this. Obviously, this is the SVB breakdown. If we continue to look at other bearish examples, look at back here, right? If you take a look at that, this volume is well elevated beyond what we got from last week on Thursday. So the volume does not compute. And also, as we'll see in the market internals in just a moment, internals don't compute. There's no suggestion of stronger, more methodical sellers getting involved on the Thursday session. The last thing that I would point out on the daily time frame chart here is Friday's close. If Friday was going to be follow through for the sellers or even just bearish consolidation, we should not have recaptured the 50% retracement of Thursday's breakdown, and we should absolutely not have closed above the top of this as a balance range. This is look above and fail. We've basically fulfilled that target by coming into the bottom end of the range, and now we're back above the top of the range. So if anything, short two piled in at the worst location underneath 454 are in a world of hurt as of Friday's close, which is above the top of the balance range. The most optimistic look on the daily time frame chart for shorts would have been an inside bar that was a 3-bar play in the downward direction that looked like this, sets up the equal low flush through this area, and then we'll look for that deeper weekly pullback to 444. All right, so that's what I'm seeing from this perspective. A larger downdraft may occur if we clean up these lows at the 451.50. The one thing I would carry forward is that because these are so precise, if tested, you should expect them to break. And then there's two outcomes that can take place. They're both bullish in my estimation. I know you probably don't want to hear that, but they are, right? If we sweep the low and come back into the range and do something like this, it's a higher low, it's a look below and fail. Just like this is look above and fail, this would be look below and fail. The target over time would be the top of the range. That's bullish situation number one on the daily time frame chart. Bullish situation number two is that yes, we do break down underneath the 451.50, we go lower high, but then we're looking for a weekly deeper pullback to 454. I mean, I think everybody can agree here. The market feels like you're chasing and chasing and chasing these higher highs. It would be much more comfortable, much more optimistic to get involved with some give and take and try to buy a deeper weekly pullback to the 454. I think everybody would be content there. The bears have a little bit of downtrend. The buyers can get involved at better prices, cleaner stop loss, so on and so forth. So that's a little bit of projection here of what I would like to see on the daily time frame chart. But let's take a look at the hourly and actually remain evidence-based for what we could imagine into the upcoming week, early on that is. So here's the balance range as we just pointed out. There's the beginnings of your gap fill reversal on the Thursday session. Nothing about that activity is at all indicative of stronger sellers, right? This is inventory correction. Then the buyers start to step up and do their job off of the prior high of day, which just so happened to be the FOMC high. The news comes out and we get the straight shot lower. What's most interesting to me is, once again, Friday's follow-up session opens at 456, the top of the balance range from in here, and notice the multiple lower wicks that attempt to go back down into the range, attempt to go back down into the range, but close above 456. If the sellers were going to have something going on, if this ultimately was going to turn into a lower high, you should have moved back down into range. We would have looked for a lower high. Then it's once again a look above and fail. We would retarget the bottom end of that range. So going forward into the coming weeks worth of trade, I think it's fairly simple. Buyers have an edge as long as we're over 456, breakouts up and over 457.65. cautiously long for moves in the upward direction. Upper targets start to become 461.50, upper edge of the expected move. Then beyond that, this is a pie in the sky target. Not advocating for that this week, obviously, but 465.25 is your next structure. On the downside, I still would not be convinced short on this market. If we get down under 456, I would be looking for an hourly higher low from here to here at 454.50, then doing something like this into the future. So still trying to buy pullbacks at 454.50. The only time that this market flips to neutral / bearish is if we get underneath 454, not 454.50, 454 for consolidation down here. And then we flush the equal lows for that daily situation we were just describing underneath 451.50. This is the only bearish sort of situation that I can see into the coming weeks worth of trade. Let's see if we have any confluence with our anchored VWAPs. Let's throw those on very quickly. Here we go. And what we'll notice, let me auto zoom this for us. There we are. We're above all of the anchored VWAPs. So even if you want to anchor one to the tippity top of Thursday's activity, you're getting confluence 456. That makes total sense. If we're in here, the buyers have an edge. Anybody who is short dead on the lows, anybody quote unquote average short from Thursday's session is underwater if they're holding into Friday's close, right? That's based on the anchored VWAP here. Once again, the anchored VWAP from this prior high, still keeping shorts off sides for anybody who is committing down here or at the lows, would be your higher low pullback over 454.50. We talked about that as a situation as well. That would be bullish, staying above that anchored VWAP. And then things get a little bit dicey, as we pointed out, underneath the lows in here. Anything from a Fibonacci perspective, and then we'll move on along to some supporting evidence coming from the low up to the top. Again, folks, you literally can't make this stuff up. The 38.2 is stacked right at our key line in the sand from a daily perspective at 451.50. As long as we're above that, technically speaking, this is nothing more than just healthy bull flag consolidation up here. Over time, we would look for follow through in the upward direction. Then the last one I would share with you before we get into some supporting evidence is just taking out the fibs specific to Thursday's range, right? We always talk about the reclaim of the 61.8 being a bullish phenomenon. We did close above that on the Friday session. So as we know, the more time we can spend over the 61.8, aka the more time we can spend over 456, the level we were just advocating for, the higher the odds of a 100% retracement. So I'm not seeing any evidence for stronger sellers. Let's take a look behind the curtain at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Net on the week, internals are more bullish than bearish, which is an incredibly important thing to make note of here. It's not strong bullish, but it is neutral to bullish in the upward direction. Net flows on the week are positive, but not substantial. The advanced decline line spends more time this week over the zero line as opposed to in negative territory, and the cumulative builds, although they're not impressive this week, are more so bullish than they are negative here from the panic sell on the Thursday session. Speaking of Thursday, let's look very closely at what was taking place prior to the announcement. Volume flows prior to the announcement were net flows positive into the market, inflows. The advanced decline line was technically over the zero line. I would concede, obviously, that it's moving lower towards the zero line, but it was positive ahead of the announcement. And the cumulative build, it was mildly negative, but as we start going for that gap fill reversal over here early on in the session, it was trying to work its way back towards the zero mark. Of course, it does become substantial into the close, getting close to that negative 5,000 mark, but for the most part, this is panic style selling. Think of it like a money manager. Think of it like a trade desk. If you're trying to sell a position for a client or an order comes across your desk to fill, or just take profit basically, not even initiate new money shorts, you're trying to beat the VWAP. Is anything about this panic waterfall type sell indicative of trying to beat the VWAP? The answer is absolutely not. So it's not methodical type selling that we see on Thursday. It's emotional, get me out, I'm panicking because of the announcement from the Bank of Japan. Aside from that, on the week, the internals were much more bullish than they were bearish. And we could take it one step further and say, okay, well, what about Friday's follow-up? In terms of Friday's net volume flows, they were the strongest flows on the week in the upward direction. The advanced decline line opens in trend higher zone. It's the best read that we have on the week. In terms of the cumulative build, it's the strongest read that we have into the week. So overall, there's no follow-through on the Friday session. Thursday is completely panic. I'm not seeing the evidence that stronger sellers are getting involved, but there's also not a ton of evidence that the buyers remain overly confident. Notice that all of the reads on the buy side prior to the Friday follow-up day are really more mild than anything else. So the argument isn't to go, buy this market with both hands, second mortgage, looking for the, new all-time high this upcoming week, but it's certainly not a short indication. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What's going on here from a value area and point of control perspective perspective, on Thursday specifically, value area and the point of control are left higher in the profile instead of migrating lower with price because, of course, we do know we closed weak down towards the lows. Thursday also experiences a double distribution separated by the single prints from J period right here, and this is noteworthy because, of course, on Friday, all of the price acceptance is in distribution 1, aka your upper distribution where the bulk of the value was from the Thursday session. Notice that on Friday, we look into the single prints, and technically we treat single prints like a gap, right? There's no follow through in the downward direction to repair the single print structure, and of course, the value area and point of control on Friday are stuck in the midpoint of Friday's range, but nonetheless in distribution number 1. Now, we do have a poor high and a poor low on Friday's session, so either end could use some repair here. What you would really want to be focusing on is if we do repair the poor low, if we can come back above this area, which I would say, basically use this as the equivalent of 456 on your SPY, the top of the single prints there, that level. It's basically half back as well, kind of interesting there, but 45.94, as long as we're above 45.94 on the ES, buyers have an edge. I would be neutral in the single prints, and from a bearish perspective, we might start to change our tone if we're getting price acceptance, if we're getting value building out in distribution number 2 from the Thursday session. That would be underneath 45.82. Underneath 45.82, we will change our tone, but everything about the profile thus far would indicate that we have trapped shorts and we're starting to build out value in the upward direction. If we can repair the poor high, obviously we're looking for those upper targets we just discussed on the SPY. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that communications led the pack here, up 4.5%, and at the bottom of the barrel we're seeing utilities down 2.22%. So a risk on sector leads and a risk off sector is the laggard. What about the heaviest weighted sector? It's the XLK. It's pretty neutral, only up about 0.58%, but nonetheless, let's keep it very simple through the sector lineup on today's session. Is there any follow through on the sell side on Friday is the question to answer. In the XLC, the answer is no. Brand new higher high, strong opportunity for a higher low over 68 basically. This chart is looking more bullish than bearish for consolidation and a gap close overhead. That is a helpful force for the bull case in the broad market. XLB, any follow through on the sell side from Friday? Nope, this looks like a balance range to me. If it does break, small upward pressure, but it is nonetheless upward pressure for the S&P. Energy, any follow through in the downward direction? This is a lighter weight but D for defensive sector. No, we did experience technically a look below and fail, caught ourselves for support at the daily 200 SMA, and we've closed back above 85. I would not be surprised to see energy rotate in the upward direction towards 87.30. As long as it's not exhibiting leadership, no problems here. Remember, upward pressure is still upward pressure. Let's take a look at the XLY. Any issues with the XLY? This is interesting, of course, because we do have that same bearish engulfer phenomenon from Thursday, and then Friday, is there any follow through on the sell side? The answer is no. If we can get over 172.60, that would be a bullish look for the broad market, noting that you're probably going to get some squeeze out of the folks in here. Of course, keep in mind Amazon earnings. That's the next biggest constituent for the XLY. It's going to be on Thursday after the close, but nonetheless, the chart does not look overly aggressive in the downward direction. With the weak close on Thursday underneath the bottom of this as a bear flag, why was there no follow through to get down to the big weekly retest at 167.25? Once again, not seeing the evidence for stronger sellers. We'll change our tone when and if we reattempt this breakdown, but nothing about Friday would indicate that just yet. XLP, D for defensive. Any issues up here? No follow through from the sell side on Friday. Upward pressure is upward pressure. Next up, XLI for industrials. No follow through on the downside from Friday. Good to go. Brand new all-time highs basically if we can break that inside bar, 3-bar play in the upward direction. XLK. Right, this is worth spending some time on. The heaviest weight risk-on sector for the market. On Thursday, once again, what do? We break down through the lows of this entire range. We technically cleaned up the lows from here. There's minor excess on the lows of Thursday and Wednesday's session. Now where do we find ourselves? In the upper 50% of the Thursday breakdown. All it's going to take is a little bit of a break up and over 178.75, and I think you see some squeeze for the equal high. Would we have to contend with the double top? Yes, we would, but once again, it is not a double top until we get more firm price acceptance after making that high and then breaking for a lower low here underneath 175.70. Not concerned about the chart yet. Ideally, it does see some lift though over 178.75 to help the bull thesis. Let's take a look at utilities, the sector that got absolutely beat up this week. Is there any follow through from the selling? The answer is yes. There is some follow through from the selling, Matt. This is bad, right? Well, not so fast. XLU is a lightweight D for defensive sector. It's really not the end of the world here to see utilities see some follow through in the downward direction, and even at that, we're coming in for a retest of this sort of, you could maybe classify it as a very loose weekly double bottom, right? So all good from that perspective. We're not falling off of a cliff. We're not making Armageddon new lower lows. We're kind of all right. We're doing okay. Real estate with higher rates obviously being the issue. From the Thursday move in the upward direction. No surprises to see it come in a little bit, but still above the top of this retest zone. Even at that, real estate is a little bit more defensive and obviously has more to do with the wealth effect. Healthcare, this is interesting, right? Healthcare is D for defensive, but as we know, the second heaviest weighted sector by market cap. What do we see on Friday? Look below and fail on the bottom of this as a balance range. That is a bullish indication. The fact that the sellers could not get any follow through the thin structure that we were breaking out through here, breaking underneath support at 134.75. So the close back in range would indicate to me, just like the energy chart basically, can we see the rotation to the top at 136.85? Being the second heaviest weighted sector, it's going to be pretty tough for the market to fall off of a cliff if healthcare is moving in the upward direction here and the chart does look more bullish than bearish. XLF, last but certainly not least, what do we see going on over here? I will concede, yes, of all the heavier weight risk on style sectors, this is the sector with the most follow through in the downward direction from the Friday session. Obviously, we do not close green, but what's most interesting about this is, once again, we take out the low of Thursday and there's no follow through and we close back inside of Thursday's range. This would be a much different looking chart if we did produce a solid red bodied bar and we closed underneath. And even at that, we're coming off of higher highs in this overall trend sequence. Can we still afford a higher low pullback here at 34.65 or even deeper than that, possibly at 34.20? Absolutely. So is this chart damaged? The answer has to be no. So even though we saw some aggressive downside on Thursday, the sectors would indicate that there was no follow through across everything that we consider important. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set this one up. And I think that the ratio grid does a great job of bringing us back to reality and not getting overly bullish, right? The internals did a good job of that as well. But as we're rifling through the sectors, we're like, hey, everything looks fine and dandy. The ratio grid would tell a slightly different story with some weakening in the overall relative strength from the tech sector here, which, as we know, is the heaviest weight risk on sector. The fact that this is starting to go more sideways and it's flirting and getting tangled around this upward sloping 50 SMA, it leaves the opportunity for a bit more to be desired here. I'm not saying it's bearish, obviously, but it's definitely not as bullish as it wants to be if we're going for a full-blown risk-on look. This is fine underneath a descending 50 SMA. The XLF really wanted to get more price acceptance and like continuation over the 50 SMA. Not saying that there's not an opportunity, but the pullback on the end of the week session in here, it's not the best look. Ideally, once again, this would have produced like consolidation high and tight and then gotten follow through here. So we'll keep an eye on it. The XLY, again, not the end of the world by any stretch of the imagination, but still some tangling around the 50 SMA here. Ideally, it would have come in for a sharp test and rebounded away quite quickly. XLI, it's kind of neutral and sideways. XLC, give some credit where credit is due. Big recovery effort, obviously, on the meta earnings and the big gap up that's there. So this is fairly impressive in the upward direction, and as we know, it's the closest tie to a risk on sentiment to the XLK. In terms of the bottom four for risk off, we're also not risk off, right? If you take a look at what's going on here, not a threat, not a threat. Energy is curling lower. You want to get it back down underneath a descending 50 SMA. It's not currently a threat, but we're keeping an eye on it. Overall, the takeaway here is that we're not full-blown risk on, a little bit more neutral than that, but we're also not risk off. There's no reason to panic just yet. And another indication of that would be if we take a look at the XLK over the XLU. So this is tech versus utilities, obviously aggressive risk on versus aggressive risk off, holding at an upward sloping 50 SMA. Notice the reaction here a little bit sharper off of that 50 SMA. That's ideally what we would have liked to see out of the XLK over the SPY itself. We could do the same thing and make a similar comment to what's going on here with the XLY over the XLP for risk on versus off, discretionary versus staples, right? And overall sideways, but it's still well above an upward sloping 50 SMA. We're coming off of a brand new higher high. So don't get me wrong, it's not a risk off look, but the risk on feel just isn't as strong as it once was. How about the dollar? It certainly made a stand up and over 101 on the Thursday session with the Bank of Japan news, and that shouldn't really come as much of a surprise, but I want to illustrate to you the risk out of the dollar, right? What we want to avoid here is a look below and fail, aka a higher low back above 101 for the full retracement up towards 105.65. In theory, that upward rotation out of the dollar would put downward pressure on equities over here. The one saving grace about the whole Bank of Japan issue that took place on Thursday is if we take a look at the yen, you could look at at the pair, USD JPY, and let's go to like a 15-minute time frame chart just to illustrate here. If you zoom in, we're unchanged from when all of this began, right? This is where it began. This is where the dollar takes off, right? This is where we get some chop out of the pair. We're unchanged now. So is there some sort of like saving grace in your back pocket for the dollar maybe getting back down underneath 101? It's a possibility. Even if you don't like the pair, you could take a look at the futures, which would be the 6J, I believe. Yes, J for Japanese yen, there it is. And once again, unchanged out of the yen futures. So a flash in the pan, really volatility and uncertainty from the Bank of Japan, not so much a big change in market dynamics that are being priced in yet. We'll continue to keep an eye on that. Let's take a look now at the gold contract and see what's going on from a gold and silver perspective. Gold's a little bit tricky because of the contract roll that we just experienced. I would honestly want this over the 2,000 to be more of an indication that the dollar wants to get down underneath 101, which once again would be your bullish relationship for equities down below. If gold does start falling down underneath, really, it's going to be your 1955. If we get down underneath that, that's a larger cause for concern. How about silver? So we can avoid looking at the contract roll. This is a bit of a concern as well. For a higher dollar, or at least staying over the 101. We talked about the retest of this level at 24.41. Notice we've already got a lower high and we're back down, even producing a very nuanced lower low into the end of this week. So I'm not in love with what's going on with the silver rotation right now. Really, at the end of the day, it's going to boil back down to the dollar and what's going on with the 101 pivot. So if anything, just to simplify things here, go back to the dollar. If we're over 101, cautious. If we're underneath 101, a little bit more of a bullish edge for your markets in equities down below. Let's take a look at the TNX. The TNX, really took a move in the upward direction there on Thursday as the TLT, right? I know that obviously we're talking about 10-year and 20-year here, but if we go to the TLT, just as an illustration, when the BOJ makes their announcement, right, all of a sudden money gets sucked out of the U.S. side of things to go back home to the domestic investments, and that kind of puts pressures lower here on bonds, thus driving your rates higher over on the TNX. It's just like a general relationship. But nonetheless, if you remember back to the XLK chart we were just looking at, there really wasn't much damage done to the XLK chart. I'm just going to bring that up now as it's fresh in the mind, right? We never really got some follow through underneath these lows. So the fact that the TNX shot higher like that and there's no follow through out of the XLK makes me a little bit skeptical of the TNX, honestly, and at least the market's perception of it persisting up in the, up and over like 4%, give or take. Let's take a look at the inverted ZT just to see what's going on from this futures perspective. So this is the inverted 2-year, right? And this is what the Fed funds rate closely follows. As long as we're going lower high, and we're still on track for that currently, that's the indication for no more hikes into the end of this year. If we go higher high over the 101.050, that would be an indication for getting that secondary rate hike likely in November. And if we get the lower low, the cat's in the bag, no more rate hikes, and likely pricing in cuts sooner rather than later underneath the 102.015. And just a reminder, this is obviously inverted. Let's get on over to the tracker tool. So you can clearly see no impact from the Bank of Japan decision here for the Fed's expectations moving forward in the month of September and even out to the month of November, where we know that this is really where the risk of that secondary rate hike was coming in, still expecting a pause at 525 to 550. If we go out to the probabilities tab, this has been updated based on our Wednesday video as well. So this is properly in the right column now. And you can also see that the first cut is now being scheduled for May of 2024. So keeping higher for longer in the forefront of our mind seems reasonable, especially given what Powell told us on the Wednesday press conference post FOMC. They're going to be data dependent. They're going to be watching the labor market specifically to determine whether or not we can continue to withstand more rate hikes. And speaking of, let's take a look at the economic calendar. What did we get into the end of last week? I mean, GDP coming in at 2.4 versus 1.8 expected. That's not indicative of any sort of recession. Unemployment claims came in at 221 versus 234 expected. Labor market remains strong. What else? Durable goods comes in at 0.6 versus 0.1 expected, so demand remains solid. If we take a look at core PCE, it comes in at the expectations 0.2 versus 0.2 expected, so inflation is not ramping back up in the upward direction. Employment cost index 1% versus the 1.1 expectation. No wage price spiral. So the economic data continues to remain strong, and that would give us the room to basically withstand another rate hike if Powell wants to give us one. Why might he give us one? Well, if we take a look at this chart over here, we haven't brought this one up in quite some time, but the DBC on the very bottom of this as a cycle chart is starting to pick up in the upward direction. So If inflation is going to reemerge with commodities increasing in price, maybe we get more rate hikes into the future. But with the economic data that we got in the past week's worth of trade, everything about the information that we just walked through over here is not indicative of recession. The market is willing to, or I should say, is able to withstand another hike into the end of this year. What about the earnings calendar? Let's take a look at some earnings results first. So we're above the 5-year average in terms of beats out of the S&P, and that's your big headline up at the top right here. The next thing is that the earnings surprise percentage is below the 5-year average. However, what I want to highlight is the big three, even the big four, you could call it, who are actually beating, right? The largest positive aggregate difference between actual and estimated comes from consumer discretionary. That is a heavier weight risk-on sector. Information technology gets the second largest positive difference between actual and estimations, right? So their beats are the highest of all the beats out there in the sector. Same thing with communications as well as industrials down here at the bottom. So we're seeing the beats and we're seeing the surprises, the positive surprises from the right sectors from a risk-on perspective. The earnings data thus far is pairing nicely with that narrative. We could also look at revenue surprises this way. Once again, you can see consumer discretionary, industrials at the top of the list. Industrials, not the biggest risk-on sector, but it's definitely more risk-on as opposed to defensive. Financials are also up here. Healthcare, not the greatest. Infotech, it's also beating out the S&P as a whole. Utilities getting slammed down below at the bottom. And once again, this is D for defensive. If anything's going to take a beating right now, this is where you want to see it being basically hit. Utilities. Let's take a look at earnings surprise, right? This is basically the graph of the verbal that we just walked through. There's your consumer discretionary, there's infotech, there's communications, and industrials all above the S&P 500 in terms of percent surprise. That is what you want to see. Remember that earnings are not so much about the actual number, but it's how much better than the expectation were we, and what is the guidance going forward. We'll talk about guidance in next week's review once we get Apple and Amazon. Speaking of, here is your earnings calendar after the close. Amazon and Apple on Thursday. That's where the fireworks go off. Some other honorable mentions, of course, AMZN. That is going to be on Tuesday after the close. You could take a look at PayPal and Shopify in here. Coinbase, maybe an honorable mention. Same thing with Block, but Amazon and Apple really take the cake. Let's move along and look at some more data. How about the risk appetite charts? Obviously, the TLT got beat up on the Thursday session when foreign investors pull out to go back home and be domestic, but overall, the ratio continues to move in the downward direction, which would speak to a stronger risk appetite for equities down below. If this relationship is going to be broken, we could take a look at something like short-dated bonds, and I will concede if we zoom in on these charts, there was definitely an uptick on the Thursday news, but I would just remind you that we're talking about a change to a 10-year-long policy, and this is a small uptick relative to what we've seen in the past. This is not taking out new higher highs. This is not signaling a recession. This is some volatility around policy, which once again, it's been an unchanged policy for about 10 years. Walking forward, it's no surprise to see that we saw some uncertainty there as we move forward into the future. What does this do? Does it start to trend higher aggressively, or does it mellow back out? That will really be the tell after maybe a week or so of digestion of the news that we just got. What about the HYG from a divergence perspective? It is still divergent. So once again, this does pair nicely with the cautiously long sentiment that we have in the S&P down below. Notice that we're making a series of lower highs and lower lows, whereas the market is going for equal highs and equal lows, or maybe slightly higher highs and slightly higher lows, right? So cautiously bullish from the divergence out of the HYG. And if we sum it up with the Bitcoin chart, what's going on over here? Once again, no stronger indication of a sell. Speaks to overall risk appetite in financial markets remaining elevated. Nobody's really scared right now based on everything I can see from what we've looked at. How about the market breadth? New highs versus lows holding over the zero line. That does strike me as a bullish indication. If we take a look at the SPX A200R, it goes flat as we get the big Thursday drawdown. No issues with stocks over the 200 SMA in the S&P 500. What about the SPX A50R on a daily time frame chart? We're still up inside of our golden zone here over the 0.8, threatening a move underneath it, but even at that, a mild pullback would not be the end of the world for all the reasons that we've discussed on the SPY weekly and even daily time frame charts underneath that 451.50 area. Let's take a look at the RSP equal weight S&P. What's going on with the equal weight S&P? If we take a closer look, it did not have as strong of a rebound on the Friday session, but nonetheless, the bearish engulfer did not get any follow through on Friday. So, most of the same sentiment still applies. And even at that, if we do see a deeper pullback out of the RSP, anything over the 150 mark is still a weekly higher low, retesting this breakout point from back here. So not overly concerned with this one. It would be better, obviously, if it wants to start playing more nicely and syncing up with the S&P. Look at how much further the S&P weighted is above this prior pivot top as compared to, oops, sorry, that's this one over here. This distance, of course, right here versus this distance, we're right on it. All right. So it still has some work to do. Please don't misunderstand what I'm saying. We're not completely out of the woods here. The market does need to continue to make improvements, but it's not the end of the world from a trend perspective if we do see a pullback out of the RSP. Let's take a look at the Dow. What's going on with any Dow divergences? None. This is still above the breakout. This is still above the breakout. Speaks to everything being A-OK for the S&P down below divergence-wise. VIX volatility. How low can you go? Again, if Thursday was going to be any indication of stronger sell-side activity, more fear, more panic, more mass selling, you probably would have gotten up and over the 15 handle in the VIX. Certainly did not, and we remained depressed on the Friday session. Let's take it one step further behind the curtain, taking a look at the VVIX. This as well. On the Thursday breakdown, did we breach the 103? The answer is absolutely not. And on Friday, we find ourselves low once again in the overall range from back here. When and if we approach 75, we will start thinking about the complacency zone. Let's take a look at volatility futures for all of the purists moving into a deeper backwardation, and no issues with the one-day VIX over here. Overall, volatility tells us once again that Thursday, just a flash in the pan, nothing major. QQQ monthly time frame chart. What do we see here from a candle structure and location perspective? Very similar to the SPY with a solid green-bodied bar. Not a whole lot of upper or lower wick to read into from a psychological perspective, and with 1 day left in the trading month, the intended close is towards the top of the monthly range, so buyers do get a check mark from a structural perspective. They'll also get the location check because we do have the bar-to-bar higher low, as well as, of course, a higher high. So 2 for 2 goes to the bulls in terms of the inverted head and shoulders. The pattern is loosely there. The right shoulder is not nearly as well defined as the SPY, obviously, but nonetheless, your neckline is close to 320, and for a monthly break, retest, and monthly higher low, that would certainly do with lows, higher lows, and higher lows on the monthly time frame chart. So 320 is your monthly line in the sand. I would also point out that we're well extended through the measured move target of that pattern, as well as prior structure in here, which was closer to, if I hover the cursor, 370 even. Obviously, we're trading closer to 380, 350 as of Friday's close. I also want to point out the same phenomenon we discussed over in the SPY. I would prefer that you start thinking of this as the opportunity for a cup and handle or even a bull flag, and not so much a double top. The QQQ is interesting though, because if we remember back to the dot-com burst, this was much more so a double top that did work out, where we did get some aggressive follow through underneath the neckline. The difference between this though is that the double top played out over the span of a year, whereas if we take a look at where we're currently trading, you would be talking about a multi-year pattern playing out here. Something really has to be going wrong with the tech sector as a whole. You would have to basically have a paradigm shift in the world to move away from technology if a larger downside like that is going to be in play, right? Some sort of move underneath 260 in here would be pretty incredible, and obviously take much longer than just the span of 1 year. So the double top, it could be in play, but until we approach 260, it's not on the forefront of my mind. A couple of Fibonacci perspectives before we move on down to the weekly. If we go to the low to the high, so sickness low to high, you'll notice that once again we are above the 38.2. This one did go for a deeper pullback. We've been talking about this the past couple of monthly closes at the 61.8, but it did make a stand where it needed to make a stand. Remember that deeper pullbacks that get beneath a 61.8 and start playing around in here, not that great. So obviously we avoided that look, and the chart does look better as opposed to worse with the hold of that structure. If we take out a move from the all-time high to the October lows, the monthly closes are well above the 61.8, so it's the exact opposite. In this case, we're expecting increased odds of a 100% retracement over time. If we come in from the October lows now, if we could get a click, thank you, Thinkorswim, to the top over here, the 38.2 is much closer to the 50% retracement of the drawdown from top to bottom in the October move there, and that 50% and that 38.2 are closer to the 336 to 332-ish zone. On the monthly time frame chart, if we didn't come in for a full test of the 320 breakout point, the neckline of the inverted head and shoulders right here, the ideal location would be above that at, once again, let's just round here, 335. But what you'll notice is that the 38.2 and your 38.2 from here are the neckline of the inverted head and shoulders. So just building the confluence case at 320 for larger downdrafts out of your QQQ if we do get an Armageddon type sell. Nothing about the chart currently, once again, would suggest that this is even remotely, close to being in play for not only the coming week, 2 weeks, 3 weeks, I would say the coming month, right? It would really be a nasty, nasty month of August if we did something like this. I'm just not seeing it based on the evidence out there in the market. So let's continue on down through the time frames. Weekly time frame chart, as we know, we'll do the same thing. We did produce a green bodied bar. What's most interesting about this is that we did take out the inverted hammer low. There's absolutely no follow through from the sellers over the last week's worth of trade. So if there was going to be some larger downside that was brought in, I would have imagined that it came from this inverted hammer taking out the low, then making the full move back down into this as a weekly balance for your look above and fail. It simply did not take place. I would have similar comments in terms of the trend reversal here on the weekly. Higher high to then lower low underneath the soft lows. We talked about 360 last week being confluence with our anchored VWAPs, there we go, from the AI Mania breakout, right? This is at 361.50 now, so we're off by about $1.50, but nonetheless, the point still stands. If we get some sort of move that takes out those lows, maybe a larger weekly downdraft does occur, but as of right now, the weekly uptrend is still very much so intact and alive. Let's take a look at our volume profile. Any interesting nuances to bring out from this perspective? This is in the midpoint of that range, as we talked about last week, not really in play. This overhead high volume node, maybe it's a little bit resistant right now, so I'd just be keeping an eye on that, and once again, being cautious about big time upwards follow through based on some of this overhead supply that we could be running into. This makes sense with our 320 neckline break on the monthly time frame in terms of the high volume node underneath us. Let's move on down to a daily time frame chart, and we'll get into our game plan here and what we can expect out of the QQQ for the coming weeks worth of trade. We'll zoom in on this. Thank you for bearing with me as I adjust the charts here. Expected move is bullish with a higher high and an equal low, so neutral to bullish, I should say. The big difference out of your QQQ is obviously that we did not produce a higher high already. So the larger threat on the daily time frame chart is a move underneath 375.50. Why is that a threat? Because, of course, this would be coming back down into an area of support without the support, no pun intended, but without the support of a higher high being produced on the daily time frame. So watching this like a hawk, all of the touches are also very precise. So like we talked about in the S&P, this, again, I would be more apt to look for something that does this out of the QQQ because of the weakness that's here and the daily lower high. A lower high underneath 375.50 definitely changes the daily trend. We would have a lower high, and then we would be getting a lower low, right? So that would change the daily trend, and that would be the stronger short indication across broad markets. The bullish implication would be sweeping the lows, putting in some excess, then immediately producing a higher low back inside of this as a range, and that, of course, is your look below and fail. You would target the top end on the daily time frame chart. What else can we point out here? Let's move on down to an hourly chart and build that roadmap. So very similar comments, not seeing any stronger indications of solid sell on the Thursday session. The gap fill reversal would have been much lower anyhow. Notice that we were even trying to find support well above the gap fill reversal. So buyers really stepping up with a partial gap fill on the QQQ before the news, and then still right back down to the equal lows. I would just remind you, if you didn't check out the Wednesday video, we talked about the near perfect gap fill reversal on the Monday session. Once again, if stronger sellers were going to be getting involved after the Netflix and Tesla earnings back here, we did have bearish consolidation. Why was there no follow through here? Why was there no follow through here? Why did we stop precisely at that level? I'm not seeing the evidence that stronger sellers are getting involved. Just like the SPY, I think the roadmap really speaks for itself. Bullish edge, looking for a breakout over 384.50. And here your upper target is going to move upwards towards 388.75. Anything beyond that is the upper bound of the expected move at 390.87. Then 394 is the next daily structure that we have overhead. Again, not making the call that we go here. I would be very cautious about upside in the first place, but there really isn't any stronger indication of sellers getting active in this market. There might be a decent short because we do have thin structure if we can produce only, again, this is a scalp because it's counter trend to the daily trend. It's a scalp. If we can go lower high underneath 381.75, you could trade in the downward direction through this thin structure, and then we would look for a target here for an hourly higher low at 378.50. If that doesn't hold, obviously your daily line in the sand comes into play at 375.50. So those are the roadmaps. I would probably advocate for something that does this. Looking bullish into the end of the week, this would be cautious. this. Maybe there's a scalp, but still looking for a higher low here. I will really start to change my tone in the broad market when and if we get something that looks like this over time. Once again, nothing about this interaction right here is overly indicative of that being a high probability outcome. Let's take a look at the market internals. Similar comments to the S&P. Obviously, Thursday is a complete breakdown only when the news comes out. Ahead of that, we're above the zero line. We're net positive. Cumulative tick, same thing, looking for the gap fill reversal. And Friday's follow-up, I would argue Friday's follow-up out of the QQQ is actually far stronger than what we got out of the SPY, right? So the fact that there's even less follow-through in the downward direction and there's more of an opposite reaction, getting up and over 400 million, staying up in trend zone. Remember that the SPY slowly faded off into the close, and the cumulative build here is just miles better than the S&P side of things, the NYSE side of things. Once again, there's no real short indication here until we get underneath the lows at 375.50. Let's move along, take a look at the market profile, and then round out the QQQ NASDAQ side of things. Similar comments to the S&P with value higher, point of control higher. Same thing with value and point of control higher on the Friday session. We are above the single prints from the double distribution on the Thursday session. Really poor high on the Friday, so I would expect some repair again in the upward direction first as opposed to moving lower. There's decent excess at these lows, and all of the acceptance on Friday is above and inside of distribution number 1 from Thursday. Anybody who's short from back down in here, they're in a world of hurt. The only time the sellers really build much more of an edge is if we get price acceptance in the NQ underneath 15,640 from a market profile perspective. IWM monthly time frame chart. What's going on here from a candle structure and location perspective? This is clearly the problem child. It did, of course, produce a solid green-bodied bar and a little bit more of a lower wick to read into, indicating that buyers step up towards those lows and are able to go through the opening print and close, or intending to close, up towards the top of the monthly range. But nonetheless, the IWM cannot get out of its own way. It's still stuck in this monthly balance range. Now, I will say, as long as we can close up towards the top and where we're currently trading, it's the highest close that we've seen in quite some time. Notice that these are just wicks, failure, wicks, failure. This would be a solid close and definitely a change in tone, but it's still not anywhere close to being out of the woods. If we take out some Fibonacci perspectives here, the big difference, obviously, there's no inverted head and shoulders, there's no reversal pattern, there's no even attempt for a double top somewhere up here yet. But if we come in with the fibs from here to here, notice that we're just now getting back above the 38.2, whereas the QQQ and the SPY are trading like up here in relationship to that 38.2. So that's not the greatest indication. Still struggling out of small caps. They're trying to get in gear, though. You got to give credit where credit is due. In a better world, the 38.2 would have been more firmly recaptured, or maybe it will be more firmly recaptured as we close out the month with one trading day left. But if we can get above that, if we can really start breaking out of this as a range, the next thought would be the 61.8, and lo and behold, that's sort of the bottom end of this upper consolidation. The 213 area gets pretty interesting for a retest of overhead supply out of the IWM. A big lower high there definitely needs to, no ifs, ands, or buts about it, on a monthly time frame chart, produce a higher low over this lower balance that we're trying to break out of at this point in time. There's no sense in really talking about double tops and the history of the IWM here, so let's move along to the weekly. And what we'll notice is, once again, very similar comments. Inside bar, though, on the weekly time frame chart with an equal high and higher low, trying to get some traction, but it's got to get up and over these highs closer to the 200 mark before we can definitively say we're breaking out of the monthly balance range that we were just looking at. Is it logical that the weekly time frame chart, if the broad market as a whole starts pulling back, is it logical that we could get a weekly higher low over the top of this prior balance? The answer to that question is 100% yes, and we know that that level is 188 out of IWM Russell 2000 and the small cap. So weekly higher low, as long as you're over 188, trying to make steps in the upward direction here. We of course know that from an anchored VWAP perspective, we are squeezing out of this pinch between the all-time high and the October low anchored VWAP. This one is anchored to the most recent leg that took us out of this balance, and that's slowly going to start creeping up with this one providing confluence of support. So any pullbacks, once again, that 188 level is looking fairly interesting from a confluence perspective. Let's get on down to the daily time frame chart, and we will go ahead and throw our drawing set on. We'll keep it very brief out of the IWM and small caps. This perhaps is the most interesting because on the Thursday session, we actually swept all of the balance lows. Notice that we did actually make a lower low. And the fact that we closed back, or I shouldn't say closed, but the fact that Friday opens back above the upper wicks from these back-to-back inverted hammers back above this as an overall range pretty impressive over that 196 with the cleaned up lows with the decent excess in here. I have to imagine that the structure is a little bit more healthy than what we got out of the SPY and the QQQ with those very precise touches all at the same level. Again, that's what really requires repair. This is the proper end of the auction where there is a little bit of that bang and it's not like everybody stops at the same place, right? So daily time frame chart is looking good. The overall weekly expected move is suggesting a higher high or a lower low, so neutral from that perspective. We are in this balance range. All the same comments about not seeing substantial sell side pressure, especially with the Friday close that we just discussed. If we take a look at the hourly time frame chart, I think that this speaks for itself. Over 196, have to have a bullish edge out of small caps looking for a move in the upward direction. 198.50 becomes a target, and then 200 is that weekly target we were just looking at, also the upper edge of the weekly expected move. Lower highs back down underneath 196. It can be bearish, right? And you can get some trades that go look above and fail in there. But once again, the stronger indications are as long as we're over 193.50, the larger downside in the market's really not going to come into play. If this starts to become all overhead supply, that's where I get a little bit concerned on a lower high underneath 193.50. But once again, with the Friday indications right here, with the multiple lower wicks showing us that we don't want to get, or at least the buyers are not allowing prices to slip back down underneath that level, have to give the buyers the upper hand as of Friday's close. Once again, favoring something that looks like this early on in the week. We will change our tone if we ultimately get this over time. Just not there yet. If you've made it to this point in the video, I just want to take this moment to thank you, the viewer. Obviously, today was a long one with those monthly time frame charts. It's also a hot one out there in terms of summer heat, so hopefully you're staying cool. Let's kick off the core list of companies with none other than Apple. Big reminder that they have earnings after the close on Thursday. Start tidying up any options positions that are expiring on Friday. By the time Tuesday's close comes around after that, I imagine IV starts getting pumped up. In terms of the structural chart, we are looking at bullish consolidation over the 195.35 for a big time hourly higher low, then breaks above 196.50 are playable, higher lows above 196.50 are playable. The only time that the bears build much more of an edge is on a big flush and lower high underneath 192.50. That level should be as clear as day on this hourly time frame chart. In here, you get a little bit more neutral. If we do flush these lows, I would give it another attempt for an hourly higher low here at the 194.15. Let's take a look at Netflix. What's going on with Netflix? If this is going to turn into an inverted head and shoulders, that's fine. Let it pull back, let it prove it to you with higher lows over 421.50. After that, higher high breakouts are likely going to have to be over the 431.50 to get a little bit more impressive in my eyes. Anything that's really underneath that, it's really just consolidating in this range, right? So if it's going to be inverted head and shoulders, your neckline is really up and over that 431.50 for the retracement here, and then maybe the gap is on the table. That's if the broad market, of course, is cooperating in the higher direction. If we do start breaking down, you got to go lower high underneath the 421.50 level that we were just referring to. That could possibly act as your right shoulder. If we go lower high underneath, then yes, the larger term daily downtrend in Netflix remains true, and this, of course, is nothing more than a daily lower high against the overhead supply. Let's take a look at Tesla. Let's move back on down to an hourly time frame chart where it gets clear as day, and what you'll notice is the 266.75 is in play once again. Any consolidation over the 263.50 is looking better as opposed to worse, with sellers being trapped down here. As long as we're staying above that initial Thursday pullback low, then good to go for a break over 266.75. I would start looking for probably the high or the open of this bar over here at 272.50 as a target, something that does this. So consolidation, break, intraday higher low. There's your trade in Tesla in the higher direction from their monitor for continuation. Overhead gap may come into view. If the shorts are going to make something happen, you got to get back down underneath 263.50 with lower highs to really keep these people who are shorting dead into the lows happy about their position. If that doesn't happen, I think you get the opportunity for a squeeze. Once again, 266.75 comes to mind. Next up is GOOGL. What's going on with Google? Let's go to the daily just to illustrate this point here. This balance range, anybody who is net short from that, they're off sides now. So now that we're above that, as long as we're over 128.25, good to go. That's where the gap starts from the earnings gap up anyways in the downward direction. Your consolidation, once again, wants to stay above Thursday morning's pullback low before the attempt at a gap fill reversal. That number is 131.50. So in here, bullish, breaks up and over 133.65, playing for upside next overhead target 136.75. Beyond that, you have another gap, 139.36, 140.43 133 is the closure. Not arguing for this in the coming weeks worth of trade, just telling you where that structure is. I think that this is much more of a probable situation where we grind higher towards the 136. If there's going to be a larger flush, I would not be a proponent for shorting Google underneath the 131.50. It would need to be a move back down into the gap area under 128.25. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? There's your double top that just got absolutely gobbled up. Even on the Thursday Bank of Japan stuff, it could not close the gap all the way with the sell side momentum and the catalyst. So partial gap fill, obviously on Friday, it's all undone, and we find ourselves closed right at the top. So there's a big breakout point here at 325.30. If we can get above that, there's some limited room to run in the upward direction. So make sure you have something like a 5-minute stop loss that's well defined based on some 5-minute structure or something like that that defines your risk reward and makes sure that you can pick this off as like a 2-to-1 risk reward ratio in the upward direction. Beyond that is where things really open up. 335.65 is your next overhead target. No reason to be thinking about shorts in Meta as long as we're over the 317. If we do go underneath 317, lower highs put the gap close in play, but 317 is your number. Next up is NVIDIA. This one's been kind of like, it can't really figure out what it wants to do. Like this gap up was looking good, and then of course the Bank of Japan news kind of puts a damper on that party. Then on Friday, it's still above the retest level at 460.25. No follow through anywhere though, so I'd be a little bit cautious if we're underneath the 469.50 level. I would really need to see a break and higher low above. You have to contend with this prior high from Thursday at 473.34, but from there, it's a retest of the all-time highs. I mean, it's hard to be a bear in NVIDIA right now. Watch out for AMD earnings. I'm not sure whether or not that will have an impact on NVIDIA over here. Next up, Microsoft. What's going on with the softy? The bears finally get a little bit of a win with softy, definitely remaining underneath that 342.25. So instead of being neutral to bullish like we were in almost everything else, I would say that Microsoft wants to be more so a short indication, looking for lower highs and rejections to continue if the market does move higher up against 342.25. Looking for something that does this. Better short indications would also be something that dribbles down here, goes lower high underneath 334.50. That's tradable intraday for your target down here. The big equal lows, that's a big bad low at 328.65. We know underneath that there's some room to run. 321.85 is your next downside target. A little bit more bearish out of softy. Last but certainly not least before the trade ideas is Amazon, the mini beast. What do we see over here? Again, harder to be a bear out of Amazon with the big recapture of the 131. You would have imagined if the sellers already produced a double top from here and here, we're well underneath the neckline. We rotated through the range. We even went underneath the prior range. This was like a gift to sellers to short higher prices. Why was there no follow through in the range or towards the bottom? And instead, you can see high and tight consolidation into Friday afternoon. I would be neutral in this area here. If we're over 131, hard to be a bear in Amazon. Wouldn't be overly bullish though until we can break out over the two equal highs, 132.70. Your next target would be in here from the high and tight consolidation, thin structure retracement, 134.50. Then you can walk them up from there, 136.75. A couple of trade ideas, and then you are on your way. First up on the chopping block is none other than Coinbase. COIN. This does have earnings after the close. I believe it's also on Thursday with Apple and Amazon, but nonetheless, inside bar, inside doji, 3-bar play in the downward direction here. What I like most about it, let's go to the hourly chart and zoom in, is that the attempt to rally on Friday rejected underneath prior overhead supply, right? So you are getting a rejection at a logical area. If we can break the inside bar low, looking for some follow through as a scalp early on, we're talking about Monday or Tuesday into the $90 mark. If you go through all of the thin structure back here, 84.65 does become a target. I would not want to be involved in this as they're reporting earnings. So understand that this is an intraday scalp early on in the week as long as we're underneath 96.50. If we get above 96.50, not thrilled with trying to trade that in the upward direction given the daily time frame chart and situation over here with Friday being incredibly weak as compared to some other names. Let's take a look at SQ, what's going on with Square, block as it's now called. This is the opposite, an inside bar, 3-bar play in the upward direction. Again, this is a scalp with earnings around the corner. We are noting that a move over 78.87 is an intraday trade to your equal high back here at 80.39. Here's the hourly time frame chart. There's your big aggressive sell, right? Why on Friday is there no sort of consolidation at the lows strikes me as being odd, strikes me as trapped sellers. If we can break this equal high set, notice that there's not a lot of structure there. That's a quick scalp, right? So once again, intraday 5-minute pattern, whatever, that's the trade that you're looking for in SQ early on in the week. Last but certainly not least is the triple threat MMM. What's going on with 3M? Let's take a look at the daily time frame chart just to illustrate. This has been in a pretty long-standing downtrend. It's an attractive dividend name. I will give it that from an investment perspective, but it needs to flip into an uptrend, and it's trying to do so post-earnings of its last call. If we take a closer look here, multiple inside bars are setting up on the Thursday and Friday session. Notice the relative strength on the Thursday session as the broad market and the Bank of Japan news really took everything else out with it. So a little bit of relative strength. If we can take out 113 in the upward direction over time, we're trading for 118.50 as an upper outcome. As long as we're over 110.40, that trade idea is in play. Here it is on the hourly time frame chart. We want to remain above this breakout structure from here on the earnings gap up day. That's all I've got for you in today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. I hope to see you all on Monday morning, 8:15 for the pre-market prep. And with that said, have a green trading week.